Halfway through 2024, the U.S. stock market is riding high. What adjustments should you make to your investments for the second half of the year? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right. Not sure when you're consuming this content, but recording it about a halfway point in the year into July 2024. And it's safe to say that the U.S. stock market, large cap stocks, have surpassed just about everyone's expectations thus far year to date. And you know, we don't get into forecasts. No one can predict the future. So Wall Street firms cannot predict where the stock market's going to be. They can do math and say, well, normal growth rate or where we are with earnings per share, the stock market could be around here at the end of the year. But, you know, it is a very, very complicated amount of assumptions and whatnot that are built into that. And so things can change very rapidly. Halfway through the year, the U.S. stock market, large cap stocks, essentially surpassed just about everyone's full year prediction of what the stock market, how the stock market would perform for 2024. Up over 15% halfway through the year, large cap stocks. That makes for an incredible year. That's an incredible 2 years. So there, once again, the investment truth that stock market returns are lumpy. So stay invested. So as we stand right now with such a strong start to the year, what are 3 adjustments that you need to make in your portfolio right now to recalibrate for the second half? I'll start with the obvious one, and that is you need to rebalance your investments. That's right. Hopefully you have a process for how you are investing for the long term. And that process should be anchored in diversification. Don't have all your eggs in one basket. It's going to be tempting though. It's going to be tempting, just like it has been, to have an overwhelming amount of your investments in large U.S. stocks, and that should be your largest holding. However, it's not going to be your only holding. You've got to balance that and manage the risk by having a diversified portfolio. And when you're holding a diversified portfolio, my favorite investing quote on diversification is, does diversification work? Yes. Will you like it? No. And here's why. Because you're constantly going to be tempted to make the comparison game. Well, of this diversified portfolio, which one's the best? Which one's the best? Well, for a long time, large cap U.S. stocks, the U.S. stock market has been the best, and it's been no exception to start this year. But what that means is the other areas of your investment portfolio, which cyclically just haven't performed as well right now and may do so in the future, maybe even this next quarter. Right now, your large cap position is a little bit bigger than what it otherwise should be, and your small cap or international or some of these other areas are a little bit smaller than where they should be. So how should you approach that? Well, an unemotional approach is to rebalance it. Trim off some of the excesses that were created in your large cap by that area of your investments being up 15%, and add some of that fat that you've trimmed off, add that to small cap, which is only up 2%, or add that to your international, which is only up 5%. Now, we're not talking huge, I'm not talking about an allocation change. If your overall asset allocation should be 50% in large cap, well, it might now be 52%. And if your overall mix should have 7% in small cap, it might only be 5 or 6. And so trimming just a little bit of the growth from that large cap and adding it to small cap or international or those areas that haven't performed as well, that's an unemotional, disciplined way of selling high and buying low. Hopefully your rebalance is also unemotional and it's set up on a schedule. This is one of the big decisions that you're going to make within your 401k is setting up an automatic rebalance schedule, whether that's quarterly or whether that's semi-annually or once a year. we'd recommend quarterly, and here we are at the halfway point of the year. This is another time for you to do that rebalance, unemotional rebalance, to realign and get your asset allocation, your mix, your recipe back in alignment. Second big decision you need to make with your investments to recalibrate for the second half of the year is decide how much of your equities, how much of your stocks you want to hedge. Now, this is a decision that has become more and more common recently, and by recently I mean over the past 5 years or so, because of the availability of new hedging instruments and new hedging tools. but also, guys, because when you look at the valuations of, let's just say, the stock market, you can compare it to, well, what's the price of the stock market compared to the earnings today or projected earnings, but you can compare that price to earnings, PE ratio, to where it's been in the past. And when you look at that data, it was very high. The price to earnings ratio was very high in the late 90s and early 2000s, i.e. the tech bubble. It was very low in 08 when no one wanted to own stocks. Guys, it was very high right after COVID, right? At the end of 2020 and into 2021. We are back to those high levels. And therefore, expecting, not betting on it, not just knowing for sure this is going to happen within the next year or 2 years that we're going to see a decline in the stock market, but just expecting we'll probably see that because we've had multiples expand here recently. That's prudent to do. And therefore, if you are looking or kind of looking at your allocation to say, well, how am I going to manage risk? Hedging some of your equities may make a lot of sense. Furthermore, the top 10 stocks, or really the top 7, have been what's been really driving a lot of the stock market performance. And we now have the top 10 stocks in the S&P 500 now make up 37% of the overall index. That is a very top-heavy market, and therefore, there again, that concentration might mean a little bit more volatility could be ahead. So, how much of your stock position should you hedge? If you're a younger investor, that number is probably 0, but you got to work with your CFP. If you're closer to retirement, in retirement, it might be 20%, it might be 50% of your stock portfolio you should be hedging. Still being able to appreciate on the upside, but have some defined downside protection. Work with your CFP, see if that makes sense. And then the third investment decision that you've got to make right now to recalibrate your investments for the second half of 2024 is, of your fixed income investments, of your bond investments, determine how much you should lock in at these high fixed interest rates before they go away. Okay, so this is not for you younger investors. If you have any bonds, I would argue maybe you shouldn't. If you have any bonds, it's for diversification purposes only. And don't get me wrong, if the Fed does start lowering interest rates, bond investments likely will see an increase in value. Just mathematically, that's how it works. But as you're closer to retirement or in retirement, you've got to decide, should you and how much should you be locking in these high interest rates while they are around. There's been a lot of talk this year about the Fed starting to reduce interest rates. As soon as they do so, we'll likely see these high CD rates or high Treasury rates, T-bill rates start coming down. And while they're still around right now, determining how much of your fixed income portion or bond portion of your portfolio should you lock in to these using an individual bond or individual treasury at these high interest rates, you've got to make that decision. For a lot of folks that we're serving early in retirement, we've built out and we're building out CD ladders, bond ladders, as opposed to just holding the underlying mutual fund or an exchange traded fund, so that we have more clarity over when dollars will be available and exactly what they'll be earning, because these interest rates are high. And we want to lock them in for as long as possible. Depending on the client, building out a lot of CD ladders, bond ladders, or combination of the two. All right, so those are 3 big investment decisions you can make right now to recalibrate your investment approach for the second half of 2024. Make sure that those decisions are all consistent and connected with your overall comprehensive financial plan. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.